Hello all. Welcome to video 2 of chapter 6. We're talking about business income and loss. This video is not going to have any exercises. It's mostly going to be me running through a handful of slides discussing businesses and their qualities. So when we return in video 3, we'll have more exercises to do around recognizing certain income inclusions. So let's go into the slides and we'll discuss commencing a business. So, a business is considered to have commenced when some significant activity is undertaken that's part of a regular income earning process. We've noted in the last video that profit motive is a huge standard in determining a source of income. So, one activity could not be considered a source of income before and then becomes a source of income after. That moment where it turns into a source of business income, that's when the related expenses can be deducted. If I have a hobby where I knit sweaters, I make sweaters for family and friends, that's a hobby. There's no profit motive. So the expenses that I pay for yarn and materials cannot be deducted. Over time, I get really good at it. And I say, you know what? I bet people would pay for these sweaters. And I start producing them to sell to third parties. Only once I commence the action for sale can the yarn and the materials be expensed. So it's important to identify when did this significant activity for earning income start. So this can be identified. So pretty much any activity can be a business. The moment I buy something or make something and sell it, boom, I've started a business. But there can be steps taken to establish when a business begins if we want to have a clear-cut point when we can make our deductions and claim our expenses. So one is essential preliminary steps. If we obtain a business license, if we do the paperwork to say, I am opening a business, that's a pretty good indicator that I am commencing a business. If the person's committed to a course of action and actively takes steps to create the necessary business structure. No, any expenditures that are incurred prior to commencement are not deductible. So you need to establish that this activity is for earning income, that it has business structure. So if I said, oh, I'd like to buy and resell video games, that I want to make money on it, but I never sell one, I just keep buying video games and expensing them, the CRA would say, what is your business structure? Why are you not selling any? Do you advertise? Do you reach out? Like, what are you doing? And if the answer is, well, no, I just have a lot of games, and if anyone wants to buy one, I'd sell it to them. Until then, I just play them. Okay, well, that's not a business structure. You're saying you're buying them for resale, but you're not selling them. You're not performing the action in a way to garner what would be considered a business structure. You're not acting in a way a business would to garner sales. If there's a personal element, which means if this activity is deemed to be more for your benefit than for the pursuit of profit, then those losses are disallowed as they're on the basis that there's no source of income, no profit motive, failure to commence a business. If there's no personal element to activity, business automatically considered source of income. Let's say my hobby is I give haircuts, or let's say I like to give haircuts, and I say, yes, it's my business. There's no personal element to it because I can't cut my own hair. Like this activity is for other people. So the money they give me, it must be my pursuit of getting that money that they give to me. If I'm only giving haircuts to people who don't pay me, well, then there's no source of income. But if I'm earning income from an activity that has no personal element, meaning I can't personally benefit from it at all, then that must be a source of income. If there's a personal element, the CRA evaluates if the business is being operated in a commercial-like manner. You have a lot of video games. Are you trying to sell them in a way that means, yes, this is a commercial activity? Are you trying to sell them in a way where you're actually getting sales, or are you just saying you're trying to sell them? The capability of earning income is established through having customers and clientele. So when we look at any activity, how do we determine if it's a source of income? One of the first things we look at is, has property been acquired or has an activity been started? We look at this, the criteria of having um, capital, time, and effort, or capital, activity, and effort. If you want to run a farm, did you buy a farm? If I want to resell video games, did I buy video games? Has property been purchased? Now, not that acquiring property is good when you're selling goods, but sometimes a business activity can be a service. Did I start cutting hair? When did I start cutting people's hairs? So, did I purchase a property to earn income? Have I started an activity? Have I undertaken the activity to make income? Does the activity have a personal element to property acquired? Let's say I buy a house and I say, well, this house is going to be my new business, but I don't have any customers. I don't have any clients, but I'm living in the house. That's a personal element. So if there a personal element to the property acquired, is level of activity of property owner or person passive or active? So the first two, do you have property? Are you functioning or are you performing labor? Helps to establish a source of income. Are you undertaking this for profit motive or is it for your own benefit? If there's profit motive, then we have a source of income. The third one is establishing, okay, but is our source of income active business or passive property? So that's how we determine, can we consider something a business? Now, one of the things about a source of income is we mention continuity, continuous activity. So normally when it comes to buying and selling video games, if I sell only one video game, it's hard to say that's my business. I only sold one. It's incidental. Maybe I just sold a bunch of stuff at a yard sale. It was a one-time thing. Is that yard sale my business? So they look at continuity, ongoing activity. The only thing is, some things are only traded or sold once or very infrequently. For example, if I was to buy a house and sell the house, I've only bought and sold one house. But I might have made a large sum of money from selling that house. Houses are a type of property or type of product where only selling one can still net me hundreds of thousands of dollars. So, legislation includes definitions for adventures or concerns in the nature of trade. Yes, you got a gain on only a single transaction, but did you operate that transaction like a business would? Now, these rules came into place right around the 90s when flipping houses became popular. So it's mostly applied to flip transactions. Property is purchased with the sole intention of immediately selling or selling in a short time frame and earning a quick profit. So if I'm buying video games and I'm reselling them at a profit, and the CRA says, okay, but that's a business, you have to report that income, I can say, no, I buy lots of video games. I'm just, this is just a one-time thing. It's a small thing. Well, they can say, okay, but you're doing it continuously. It's a business. Even though, yes, they're your personal games, you're buying and selling is continuously netting a profit. If I buy a house I want to move into, and instead of moving into it, I resell it at a significant gain, then the CRA wonders, did you want to move into the house or did you just buy it because you knew you were going to make money off of it? So single transactions are compared with persons who carry on the business of selling the same type of property. So they'll look at your behavior and they say, okay, well, we have other businesses that buy and sell houses. Did you behave as they behaved? Did you advertise the house? How soon after you bought it did you get a realtor to resell it? Did you just modify and renovate it and then resell it then? Like, where was our intention to actually move into the house? So examples, they look at sales of commodities, shares, bonds, anything held for a very short time. This comes into play, sale of commodities, between an investor and a day trader. So if I have some investments for my retirement, I might buy some shares and I sit on them for a very long time. But day traders are actively buying and selling trades, often multiple times in the same day or multiple times within a short time frame, like the same week. That means for the investor who buys shares and sits on them, those dividends coming in are passive. It's property income. But a day trader, it's business. This is my day job. This is my activity. I'm buying, and those gains and losses can be netted against each other because this is now business income. It's how we define the difference between these two categories. So there's a special rule around residential property flipping. So like I said, this nature and trade was a big point since the 90s when flipping houses became a big industry. So they take a look at the transaction. The main legislative rule applies when a taxpayer disposes of a flipped property at a gain. If you owned the property for less than a year, it's kind of automatically considered that you did it to flip. People buy houses to move into them. So if you owned a house for less than a year, that is an incredibly short time frame to own a house. So they assume that you bought the house for resale. So, but there are exceptions to the rule. Exceptions to the rule apply to recognize certain life events. So let's say we bought a house and then found out that we were going to have a child and there's no second bedroom. It's reasonable that we would move then. If we've recently got married and there was a breakdown in the marriage, we moved into this house, we stayed there for only 2 months, and then we separated. Okay, it makes sense in that situation that you would move again within a year. So they kind of say if you've lived there less than a year and then you resell, it's assumed to be a business transaction unless you can establish that there was a personal reason for making that move in such a short time frame. The other reason why it's important to establish that yes, we resold this house at a gain is because personal property, your principal residence, is exempted from gains. Um, but if it's considered to be a flipped property, that's not a capital gain or capital loss. That is inventory. So if it's my personal house I was going to live in for a year, no gain. If it's a second property and I resell it, capital gain. That's including income at 50%. If it's considered a business transaction, that entire gain is considered a business sale, and sale income or business income is 100% included. So defining what is business, what is personal, what is incidental capital gain affects how much of the, and not only that we include income, but how much of the income gets included. So if the taxpayer disposes of a flipped property at a gain, the rules deem the taxpayer throughout the period of ownership to have carried on a business that is an adventure or concern in the nature of trade, to have owned inventory, that is the flipped property, and deems property not to be a capital gain. Result of rules is to treat any gain, loss is nil, as business income and not a capital gain. So therefore, since it's not a capital gain, the individual cannot qualify for the principal residence exemption. So this is a big deal. They put these rules in because, so in the 90s, I know I've mentioned it, flipping houses became big business, but it became hard to prove someone's intent because anyone can just say, yeah, I bought the house, I moved in. After 3 months, I said, I don't really like it anymore. And then I sold it at a profit of $70,000. And I did this 3 times this year, but that's because I'm very picky and I just really didn't like any of the houses I was moving into. And I think they kept losing. CRA kept losing because how do you prove that this was the intention? So instead, they put in this rule to say, no, it's assumed this is a business transaction unless you can argue that there was a life event for this resale, that there was a legitimate or, substantial reason for the remove. When it comes to sale of securities, that same thing can be said that sale of securities, I bought a share hoping that it's going to go up and I'm going to resell it. So that profit motive insinuates that selling that share should be a business transaction. I'm buying this for resale. People on the stock market, when they purchase shares, want to make money when they resell that share. So that profit motive insinuates that these are inventory transactions. So there's an elective option to treat sale of securities on capital account for the year and subsequent years. Um, it's available to Canadian residents and it excludes capital treatment for specific sales if seller acts in manner similar to a trader or dealer in securities. So, what this is saying is this section 4 or subsection 4, it treats all sale of securities as capital gains and losses. Yes, you're buying it for profit, but we're going to treat that profit as a capital gain due to the unknown nature or the fluctuating nature of the stock market. And this is available to Canadian residents. But if you fall under subsection 5, this excludes the elective capital treatment if you're acting like a trader, like a day trader, where buying and selling securities is your business. So, to everyday individuals, even though this could be argued to be inventory, we'll continue to treat it as capital, but this election is not available to businesses of selling and buying shares. The thing about this elective option is you don't need to file specific form for it. This elective option is kind of assumed for all Canadian residents. So whenever you have stocks and shares that you buy and sell, as long as you're not doing it too frequently, it's just assumed that these are going to be capital gains and losses in nature. So, source of income and categorizing property. There's 3 general types of property contemplated by sources of income for business, property, and property used for personal purposes. The first is inventory. When I buy inventory, it is being purchased to be resold. So the gain or loss on sale is business income or loss. It is 100% included or 100% deductible. So buying the piece of inventory is 100% deductible. The amount I sell it for is 100% included. So my net basis, my net profit is the difference between them. Inventory concept is not applicable to income from property or personal endeavors. If I have multiple rental properties, they're currently passive income. But if I'm buying and selling them as inventory, that's business. Inventory only exists in business. Depreciable property, they form part of an income earning source. So I have, say, a machine that prints t-shirt logos. The property is associated with the business activity of printing t-shirts. But if the value of that machine should go up, it's incidental to the business. I didn't buy the machine to resell it at a profit. I bought it to make my product. So the sale results in recapture and terminal loss. The portion of its sale related to the CCA I've taken, CCA is deducted as a business expense, so recapture of it is business income, but any amount above the original cost of the machine is still considered to be capital in nature. Even though the entire thing's related to my business, only that incidental income is capital. It doesn't all have to be business income. So inventory, 100% business. Depreciable is part business, recapture terminal loss, and part capital. And then we have non-depreciable capital property. Dispositions always result in capital gains or capital losses because, again, we had that non-depreciable property for whatever purpose. We didn't buy it for resale. We bought it because maybe I bought a piece of land because I wanted to develop it. And then a couple years down the line, it was no longer feasible to do so, so I sold it. Its change in value, upward or down, was incidental. It wasn't planned for. So it maintains its capital nature. There's no requirement that the capital property be used in your income earning activity in your business as long as you held it. So I bought property intending for it to be part of the business, but we never got around for doing so. But it can still maintain its capital nature. Just want to see. Okay, we got a handful of slides. Let's just get through them. So the general principle of income and losses, this requires profit from business or property to be included in income. So any income that comes in from these sources has to be added in when business or property loss determined by the same tax rules had there been profit. So businesses can lose money, and often they will, especially when they're just starting out. So the Tax Act says once it's recognized as a business or property, you will add in all income. If it results in a loss, you can recognize the loss and you can potentially subtract it from either future business income or another income source. Any mention of income for loss for property excludes capital gains or capital losses, which are treated separately. When something results in a capital gain or loss, it's not included as part of the business income because gains and losses are treated differently. Their income inclusion's only 50%. So they're dealt with in another portion. So when we had the depreciable property, we um, we calculate the recapture and terminal loss in our business statement, in our business income. But the portion that was capital gains is not reported as part of our business. It's reported on Schedule 3, calculation of capital gains and losses. So gains and losses, because they're treated differently, are dealt with separately. But what is profit? So the term profit's not defined in the Tax Act. Profit is a question of law and not accounting. This is a court's interpretation. So despite not being defined, it's still a question of law. Now, GAAP rules, accounting principles, are not rules of law, they're interpretive aids. They're standards of practices so people can read financial statements, but they're not set out as law. So the goal in determining profit is to obtain an accurate picture of the taxpayer's profit in a given year. Taxpayers are free to adopt any method that is not inconsistent with provisions of the Tax Act, established case law principles, and well-accepted business principles. What does this mean? What this means is you have your financial statements, but the income that's noted on your financial statements does not necessarily match income from the point of view of taxes. So we have to consider the differences. We can report that income as long as it's in line with provisions of the Tax Act. So when we file tax returns, there's often a difference between what the company says their net income was on their financial statements and what their net income amounts to on their tax return. These numbers are often different. So income tax principles, symmetrical treatment is not a requirement of the ITA. We call this the matching principle. Matching principle is not an income tax principle unless a specific Tax Act provision requires its use. So symmetrical treatment in accounting, like the accrual method, says I've earned income. The expense related to earning that income should be deducted in the same period. I'm recognizing the income, the deduction applies in the same period. If I have an expense not related to this period, it will be put on the balance sheet to carry forward to when it's used. The Tax Act is much more in line with considering cash basis. So accounting is accrual, and the Tax Act uses cash basis. Did you receive money? That's income. So there's specific Tax Act provisions that kind of modify this cash basis to get back to a facsimile of what the accrual method comes to. But accrual is not a tax principle, it's an accounting one. Profit shown in financial statements is just the starting point, but the ultimate determination of income or deduction is a question of law, not accounting. So the Tax Act uses the 912-1820 general rule. These are the 4 different tax sections that affect taxable income. The Tax Act Section 9 pretty much says start with your accounting income. What was your accounting income and loss? Section 12 has additions to business or property income. What's something we would add to income that might not appear in the financial statements? Section 18 are general limitations on deductions, something that is deductible from an accounting standpoint, might not be deductible from a tax standpoint. So those are set out in 18. And then Tax Act 20 says, okay, we have limitations on deductions, but now there's additional deductions you can take. The easiest example of this is Income Tax Act 9, starting with your accounting profit, will likely include amortization. Amortization is an accounting principle. It's based on management expectations of how long assets will last or be used for. But amortization is not deductible from a tax perspective. So our Tax Act Section 9 has us starting with a number that includes amortization. Section 18 will limit that amortization. So we have to add back that expense to income. Section 20 says, okay, you can't take amortization, but you are allowed your CCA. So we've added back amortization, but we then deduct back out our CCA. There's other specific provisions. We will go through a handful of the deduction provisions in a future video. For now, I just want to finish the next slide showing accounting income's our starting point. We will add certain sections of certain amounts from Section 12. We will add back disallowed expenses, but then we get to deduct those expenses allowed from Tax Act 20. And that generates our net income, Section 3, for tax purposes. Okay, when we come back, we will talk more about business income inclusions and we'll get into the concept of reserves. This is the tax version that approximates accrual accounting. So thank you for your time. See you in the next video.